Welcome to the Achievement Apex podcast, the podcast where I share my knowledge and experience on trading psychology, strategy, risk management, and everything else that you need to know to take your trading to the next level. I'm your host, Brendan Murphy, and without further ado, let's get ready to learn something new that you can use to improve your trading results. Okay, today's episode is all about how you can use data and statistics to improve your results in trading. That means bigger winners, that means smaller losers, that means being right more times, increasing your accuracy. It means bigger average wins, it means smaller average losses, it means increasing your expectancy. Any aspect of your trading you want to improve, you can do it using statistics. Now, before I get into that, as always, I want to do my weekly trading review here. Starting off with net profit, I'm down 3.69% this week on 9 trades. I had a win rate of approximately 22%. My average win was 0.41%, average loss 0.53%, which gives me an expectancy of negative 0.32% per trade this week. Now, you're probably hearing those and saying, wow, those are pretty poor numbers. And yeah, they are. I say this all the time in my podcasts. We can't always have profitable weeks every single time. Negative weeks happen. They're just part of the process. And I like to see them as business expenses because day trading is a business, or at the very least, you should be treating it like a business. Because if you're not going to have success because you do need to take it seriously. As with any business, there are business expenses, and I like to see losses as those business expenses. I like to see them as lessons that I'm paying for. Now, why was my performance so poor this week? Looking at my entries, there was a very clear trend there, and that was that I was always getting in about an hour early. So for example, I would go short on an instrument, it would jump up over the next hour, I'd get stopped out, so then I would lose. But after I get stopped out, then it would go down, which would have been in my favor. And that happened on pretty much all of my trades. I got in about an hour early, got stopped out before I would have been accurate. So my approach next week, what I'm going to do is I'm going to tighten up the rules for entry a little bit. So it's going to wait just a little bit longer before saying, all right, go ahead and trade. What that's going to do is it's going to give me slightly less trades. However, the win rate will jump up, the profitability will jump up, and hopefully next week I will be reporting a bigger profit. And that's actually a good example of exactly what I'm talking about in this video. And that is how to use your performance to adjust your approach to improve your performance. So now getting into the main topic of the video, how do you use data and statistics to improve your trading? I've got 3 steps here for you. And the first one is keeping a trade journal. If you're not doing this, this is the most important thing that you need to do, because if you don't have a trading journal of any kind, then you literally can't do this and you've got nothing to go on. You're going to be trading and you might be losing, but you have no idea why. You can speculate as to why, but you don't have any clear-cut results to say, this is why you're losing. So step 1, keep a trade journal. Inside your trading journal, you want to track every single trade that you're making, but more than that, I've got at least 5 things that you want to track in your trading journal. The first thing is the instrument details. So for example, if you're trading the S&P 500 index, every trade you make, you want to write, I traded the S&P 500 index. You want to track the entry price. I traded the S&P 500 index. It was currently trading at $5,000 US. You also want to track the time frame that you're trading on. And I'm trading on the 15-minute chart. So 15-minute chart, trading the S&P 500. The second thing you want to keep track of is the entry details. So that means, did you go long or short? How many units did you buy? What was the time and the date that you entered into that position? Did you set a take profit and a stop loss? If so, how big was that take profit and stop loss? And what were your emotions going into the trade? So an example of that might be, I went short on the S&P 500 with 23 units at 8 p.m. on the 14th of March. I set a take profit for $15 and I set a stop loss for $10. Emotions, I'm feeling pretty confident in this trade. I've had a good day, I'm feeling low stress, so I'm confident in this trade. The third thing you want to track is the exit details. Did you win or did you lose? What was the time and date of the exit? What was the mode of exit? So that means, was it exited because it hit your take profit? Was it exited before it hit your stop loss? Or was it exited because you were just looking at the chart and you started to lose confidence and you're like, nope, I can't handle it, I want to get out. So an example might be going on that short position from before. The trade won, and that was on the 15th of March at 8 a.m. The mode of exit was the take profit since we won, and we also want to track how much did we win or lose. Okay, so we won $600 on that trade. Whatever it is, track that. The fourth thing you want to track is your reason for entry. This can actually go before the exit details, but it doesn't matter. So when you're making the entry, say, okay, why did I enter? I entered because it was at a key level of support and resistance, or I entered because the RSI was below 30, or I entered because the moving average was pointing up, or a combination of those things. Or if you're entering because you're looking at the chart and you're like, yep, I think that looks cool, I'm gonna buy, write that down. Moving average was pointing up and RSI was below 30, giving me an entry signal to go long. And then the last thing, the fifth thing you want to track is your hindsight observation. So after you've made the trade, you want to say, okay, we can see that this trade won. You want to write down why you thought it won. So my observation of moving average pointing up and RSI below 30 did give me a good entry. Therefore, I was able to get in, and I think that's why the trade won. If the trade lost, I obviously had reasons for entering, but I was still wrong. Why was I wrong? Well, if you look back, you can see that the RSI was actually trending upwards, indicating buying pressure, or you can see that it kind of was respecting a different support or resistance level that you didn't see before, or maybe there's some other price action or a correlated instrument that you weren't paying attention to. Maybe the overall trend on a bigger time frame was up when you went short and therefore you lost. Whatever it is, try to find out reasons that you think you lost, and these are important for improving your performance on your subsequent trades. So that is step one. Keep a trade journal, and they're the 5 things you need to track. Step 2 is look for correlations between your performance and between the things you track in the trade journal. So going back with the first thing on the instrument details, is there a correlation between the instrument you trade and the profits or losses that you make? Is there a correlation between the time frame and the profits you make? So for example, when you trade the S&P 500 on the 15-minute time frame, you tend to perform better than when you trade the Russell 2000 on a 30-minute time frame. So that's one correlation you could look for. And the second thing is with the entry details. Is there a correlation between the position size and how much you're winning or losing? On average, when I buy more than 50 units, I tend to lose more often than when I buy 23 units. Maybe that's because with 50 units, I become too emotional and then I exit the position prematurely. Or when I'm trading more units, I tend to win more because for some reason that puts me in a state of mind where I'm more focused on the market, looking at more details. It might be, do you win more longs or do you win more shorts? Or are they kind of 50-50? Is there a correlation between the day of the week and the time of the day? So for example, do you win more often on Wednesdays at 9 AM than you do on Thursdays at 12 PM? Is there a correlation between the size of your take profit and stop loss as to whether you win or lose? So for example, you set a bigger stop loss, you win more often, but does that tend to make you lose bigger money so that you actually lose? Look for correlations with your take profit and the stop loss. Look for correlations in your reason for entry. When you use the RSI to enter, do you tend to perform better than when you use a moving average? When you use both of them, do you tend to perform better than either of them singularly? And then with the hindsight observation, you write these down, you look at it and you say, okay, I always seem to be losing when I ignore the greater trend on a bigger time frame. So you've got these correlations on all 5 things that you're tracking now. So that brings us to step 3, which is adjust your approach. So with all of the details, let's say now you say, okay, I trade better on the S&P 500 on the 15-minute time frame. So we're only going to focus on that now. I seem to trade better when the units that I'm trading or my position size is between 20 and 30. So now we're going to trade within those bounds. I tend to perform better when I go long than when I go short. So now we're only going to take longs. I tend to perform better between 9 AM and 12 PM every day. Every day it's kind of even, but 9 AM and 12 PM are the good hours for me. I seem to perform better when my take profit and stop loss are about even, and I always seem to perform better when I use a combination of support and resistance, moving average, and RSI because it gets me higher win rates and better entries. And then the hindsight observation, when I ignore this other indicator, let's say when I ignore that the Bollinger Bands are trending downwards or the price is outside of the Bollinger Bands, then I tend to lose. So now you add the Bollinger Bands on your chart and you look out for that. So what I just said, that's like the optimal conditions for your trading. Now you adjust your trading. You only trade within those confines that we just specified, which is unique to you based on your trading data. Now what happens now is you'll trade these, your results pretty much guaranteed to be better because you have data that says this is when you trade best. And now you keep tracking these stuff in your journal. Now you get even more data. You can refine it even more. Now you can say, all right, I trade better between 10 AM and 11 AM. these are my best hours. Maybe I should increase position size a bit on these hours. But basically the process is trade, get data, and then adjust your approach. Trade using the new approach, get data based on that new approach, and then make a newer approach based on that data. Trade again, get data, adjust your approach. And you just repeat this over and over again. And this is why the people that have been around for a long time in trading tend to actually make money. Yeah, they've been around longer. Yeah, they have more experience. Yeah, they have more knowledge. But the thing is, this is basically what they do. They're always looking ways to improve their approach. Once you've been in the game 10 years and you improve your approach every single month, that's 120 approach improvements they've made. Compared to if you've only been trading for 3 months, I mean, you may not even have made any approach improvements. You may have just traded, gone, okay, this didn't work, time for another strategy. That didn't work, time for another one. And you just restart at step 1 every time instead of committing, finding out what works, improving, finding out what works, improving, and so on. And so that is how you improve your profits and losses using data and statistics that you get from your trade journal. Now, if you want to skip this process and you don't want to start from step 1 and you want to shortcut to the profitability bit, I can make you a customized trading strategy specifically for you. Now, what does that mean? That means I take your hours of the day you want to trade. If you're busy, we got it. If you have a lot of free time, we got it. We'll do more trades. If you don't like taking a lot of risk, or you do like taking a lot of risk, I will tailor that into the strategy too. I will take into account what instrument you want to trade, what time frame you want to trade on, how many trades you want to take, the size of your winners, the size of your losers, your win rate. I know how to manipulate these variables so that the strategy that you have is exactly to your specification, and more importantly, it's extremely profitable. Every strategy I make is back tested for at least a year, and I show you that back test so that you know for certain that strategy is profitable. So if you want to get access to one of these, please go to my website and book a free strategy call with me, and we'll determine what is right for your needs. You can visit www.theachievementapex.com and you can book a free strategy call there. With all that out of the way, thank you very much for liking the video. If you liked it, please hit a like. If you disliked it, please hit the dislike button. If you think it's valuable information and you have a friend that could benefit too, please share it with them and leave a comment on something else you want me to cover in future episodes. So thank you very much for watching, and I'll see you again in the next video. Bye-bye.